This is the moment executives should stop pretending frontier AI is ordinary software. When an advanced AI capability can be restricted by government action, the game changes. This is not just about one company. This is not just about one model. This is not just about one policy fight. This is the warning shot. AI capability is becoming strategic infrastructure. And strategic infrastructure does not remain fully controlled by product teams, sales teams, or customers. It enters the world of national security, export control, public market pressure, and government intervention. That means one thing for boards: your AI vendor's best capability may not always be available when you need it. The reported pullback is not just a compliance footnote. It reveals the deeper reality. Some AI capabilities are now being treated as dual-use assets, useful for defense, useful for productivity, useful for information security, but also potentially useful for exploitation, cyber offense, national security threats, and strategic advantage. That is the tension. The AI company wants commercial deployment. The government wants control. The customer wants access. Wall Street wants growth, and the public wants safety. Those interests are not aligned. That is the power game, and if you are an enterprise buyer, you are sitting in the middle of it. Now connect this to the AI IPO wave. Private AI companies can live on narrative, vision, growth, strategic investors, cloud commitments, future promises. But public companies live under a colder system. Securities and Exchange Commission reporting, quarterly results, margin scrutiny, risk disclosures, revenue quality, cash burn, customer concentration, infrastructure obligations, regulatory exposure. Once frontier AI companies go public, Wall Street will stop asking only, how powerful is the model? Wall Street will ask, how much does it cost to run? What are the margins? How durable is revenue? How much compute is required? How much capital is being burned? How exposed is the company to government restriction? And what happens if the most valuable capability gets pulled back? That is a different world. Here is the question Wall Street will eventually force into the open. Are these AI companies actually making money, or are they bleeding money behind explosive revenue growth? Because revenue is not profit. Usage is not margin. Growth is not durability. Enterprise adoption is not the same as enterprise value. And model excitement does not pay the power bill. Training costs money, inference costs money, data centers cost money, chips cost money, talent costs money, cloud commitments cost money, safety costs money, regulatory compliance costs money. And if public investors discover that the economics are thinner than the story, the market will not politely adjust. It will reprice, fast and violently. Wall Street wants a clean AI story. Models get smarter, revenue explodes, enterprises adopt, productivity rises, stocks climb. But the real story is dirtier. The best capabilities may face government restrictions. The cost structure may be brutal. The infrastructure demand may be enormous. The customers may resist runaway pricing. And public shareholders will demand growth every quarter. That creates a brutal squeeze. Regulators may tell AI companies to slow down. Investors may tell them to speed up. Customers may demand lower prices. Artificial intelligence infrastructure and chip suppliers still need to be paid. That is not a technology story. That is a pressure chamber. Here's the Machiavellian read. Everyone in this system has leverage. The government can restrict access. Wall Street can punish weak margins. Cloud providers can price compute. Chip suppliers can control supply. AI companies can push dependency. Enterprise buyers can demand value. Main Street can absorb the consequences. No one controls the whole board. But everyone is trying to control their square. The AI company wants adoption. The investor wants acceleration. The government wants restraint. The enterprise wants productivity. The vendor wants lock-in. The customer wants safety. And Main Street gets whatever is left over. That is the trap. No villain required, only incentives. For enterprise buyers, the lesson is brutal. You may be buying AI from a vendor whose core capability can be restricted by government order, repriced by public market pressure, limited by safety policy, constrained by compute economics, changed by upstream cloud cost, altered by model updates, segmented by geography, and judged every quarter by investors who do not care about your internal workflow. That is not ordinary vendor risk. That is strategic dependency risk. Boards need to ask, what if the model is restricted? What if the capability is downgraded? What if pricing changes after initial public offering? What if access is segmented by country or customer class? What if the vendor pulls back functionality? What if the economics force aggressive monetization? What is the fallback plan? If leadership cannot answer, the enterprise is not buying AI. It is renting uncertainty. Main Street will not experience AI IPOs as a clean financial event. Main Street will experience the side effects: more automation pressure, more restructuring, more subscription costs, More data center power demand, more utility pressure, more retail investor exposure, more synthetic media risk, more dependence on AI platforms, and more public market volatility if the AI trade overprices the future. If Wall Street demands growth, AI companies will hunt for monetization. That means deeper integration into work, deeper integration into customers, deeper integration into software, deeper integration into data, deeper integration into daily life. That is how Main Street pays. Not all at once, but piece by piece. Boards need a new AI standard. Do not buy AI without dependency control. Before any major AI contract, ask, what capability are we depending on? Can the vendor keep providing it? Can the government restrict it? Can the vendor reprice it? Can we switch providers? Can we cap usage? Can we operate if the model is downgraded? Can we disable AI without breaking the workflow? Can we prove ROI before scale? Can we exit without losing operational continuity? Because AI dependency will not always announce itself. It will arrive as convenience, then productivity, then workflow integration, then enterprise standard, then lock-in, then pricing power. That is how dependency becomes control. The AIPOC.AI framework is direct. Red, identify exposure. Map AI vendors, frontier model dependencies, agentic workflows, data flows, and critical business processes. Pricing risk, geographic access risk, government restriction risk, and initial public offering-driven monetization risk. Yellow, prove before scale, validate return on investment. Validate reliability, validate legal rights, validate data controls, validate security, validate fallback options, validate cost at scale, validate whether the business can operate if the best model is no longer available. Green, govern readiness. Deploy only when the enterprise can monitor, interrupt, audit, cap, switch, recover, and report the dependency to the board. Green does not mean AI approved. Green means the enterprise can use AI without becoming hostage to the vendor, the model, the market, or the regulator. That is readiness. Here is the hard warning. The Anthropic pullback is not just an AI news event. It is a crack in the fantasy that frontier AI can scale like ordinary software. AI capability may become too powerful for unrestricted release. AI economics may be too expensive for easy profitability. AI companies may be too capital hungry to avoid public markets. And once public, AI labs may face the brutal collision between safety, regulation, profitability, and quarterly growth. Wall Street will chase the upside. Main Street may absorb the cost. And boards will be left with the responsibility to know whether they are buying value or building dependency on capabilities that may be too risky, too expensive, or too regulated to remain freely available. Do not confuse access with control. Do not confuse adoption with readiness, and do not confuse the AI boom with guaranteed value. The real question is not whether AI companies can go public. The real question is whether the numbers, the regulators, and the market can survive the truth once they do. For more executive briefings on AI governance, vendor exposure, procurement strategy, infrastructure risk, and 2030 readiness, visit www.aipoc.ai and subscribe to AIPOC Powered on YouTube.